Tomorrow's job report could be the deciding factor. Does Powell go 25 or shock the market with a 50 basis point cut? What kind of surprise would it take to trigger that? More importantly, what's the S&P 500 already pricing in, and what are the key levels to watch, the risks, and how to hedge it? Let's break it down. All right, the S&P 500 right now is trading at 64.81 on the futures, up 24 points. So we have a market that is pretty calm and in its trade range of where it's been all week, now waiting for what the jobs numbers is about to come out. Now, right now, overall, the market is pretty calm going into this. And odds are that the jobs number is probably not going to be a big miss. But the interesting part is, what would the number have to be in order for there to be a 50 basis point cut? Now, Steve Englander at the Standard Charter has actually answered that question for us, because he suggesting that if the non-farm payroll comes in below 40,000 and the unemployment rate jumps higher than 4.4%, that would warrant a 50 basis point cut on the table. So overall, the market actually isn't pricing that in. When we take a look at the CME Fed funds futures, there's a 95% chance of just a 25 basis point cut. They're not even pricing in right now that 50 basis point. This would actually shock the market if the numbers came in that weak. And that would certainly cause many of the money markets and short-term interest rate markets to have extraordinary moves. So right now, that market is not pricing that in. So let's take a look and set this up. So the at the money straddle is costs around $44 for tomorrow's expiration. That implies an S&P range of around 45 S&P points, or an upper range of, let's say, 65.14 and a lower range of around 64.24. So the market is actually anticipating a rather quiet reaction. And this is the interesting part for me, because overall, the hedges for a jobs numbers miss are actually relatively cheap. And so you can go into the S&P 500 here and easily put on a hedge if you're really worried that that jobs number is going to come out negative. Now, technically, to me, the real damage on the S&P 500 happens if we had over 100 S&P point drop, where you look at all these previous lows from the last few trading weeks, just below 6,400. We would need a technical breakdown below there for the floodgate to open up for a downside selling. And the market is not nowhere near pricing that kind of volatility for tomorrow's move. So is it going to be a nothing burger? Well, we're going to find out. I'm going to live stream tomorrow and watch the reactions to the jobs numbers and see what they come in right here on YouTube. So we're going to watch how that plays out. But I want to specifically now turn to the dollar. And this is what's going to be really interesting to me. The dollar has been in a very clear downtrend since the start of the year. And what we can see is that while the bearish sentiment of the dollar is incredibly strong and consensus, what we can see is that the dollar has actually found a fair value zone. The dollar index has actually been trading sideways throughout this period. In fact, this has all of the characteristics of quiet accumulation. A lot of the cross currencies are actually setting up for weakness, as the US dollar may rally against some of these. So let's talk about them. Now, first of all, the big one is the euro. And look at the way the euro has been bullishly holding the 50-day moving average, but it has been struggling to make any bullish follow through on the upside. If tomorrow's jobs numbers in any way causes a breakdown below this 50-day moving average, the euro could be going through a much needed market correction after what was nothing short of an extraordinary bull run over the course of the first half of this year. Now, the second thing to watch is that the breakdown has already started on the pound sterling. You can see the breakdown candle happened on Tuesday with a decisive break to a lower low below the 50-day. But then we take a look at that US dollar yen, which after holding a Fibonacci retrace and finding support along its 50-day moving average, is actually attempting to bull break out. At the same time, we have that US dollar against the Canadian dollar, the CAD, actually holding its Fibonacci's back above the 50-day and again trying to turn up. Now, we're not saying that the dollar is going to do a big breakout, but you can clearly see against these cross currencies that many of them are setting up for that. The question is the jobs number going to be the trigger to start a trend move? And this is something that the market would be shocked by, because everyone is pretty consensus bearish on the dollar, and yet the dollar has been quietly accumulated. A lot of these cross currencies are turning, and so will the jobs numbers trigger this? That's something I'm excited to watch. Now, the next thing I want to talk about is the 10-year yield, and what we can observe here is that there has been a very clear downtrend in yields, persistent lower highs in each one of these sequences, each one of them just basically fib retracing and breaking back down below the 50-day moving average. So we have a clear trend of higher 10-year yields, 10-year bonds and lower 10-year yields. The question now going into tomorrow's jobs numbers, we're at the edge of a cliff on these yields. It will a weak jobs number suddenly spur a bond rally as the yields break down toward 4%. We're right at the edge of the cliff here, and we're going to watch to see whether this is a trigger point for these bond moves. At the same time, when we take a look at short-term interest rates, I'm going to focus on the December 2026 SOFR futures. This is looking at anticipated interest rate levels into the end of next year. And so they've already been pricing in interest rates down to 3%, something in the ballpark of about 5 rate cuts by the end of next year. So you can see this has also been working its way higher, slowly implying a more dovish Fed. If we see the jobs numbers clearly miss and there's big revisions, the question here is that will this break out? Will we suddenly see another 25 basis points being priced into Fed cuts? Lots of really interesting charts going on here, and I'm looking forward to covering them all tomorrow to see what these reactions are. So just to recap, S&P 500 is an implied range of about 45 points, or going into tomorrow's jobs numbers. We have the dollar and the interest rates all at very important inflection points, and the jobs numbers may send the markets either into a frenzy and or could end up just being a nothing burger. We're going to find out. So we're live streaming at 8:30 a.m. Eastern time when the jobs numbers are coming out. We're going to have our Q&A open, so you can come in with some questions. So looking forward to see many of you online for that. See you then. Thanks.